Good afternoon, everybody, and welcome to the first in the Heriot-Watt University Trading Investment Club weekly market updates. Today we'll be exploring some of the current issues affecting the markets, starting with the equities markets, moving on to commodities, and then moving to the currencies markets, with a small talk later on about the upcoming news coming out of Europe, America, and the UK. So we're going to start off with the obvious choice, which is the Ukrainian-Russian conflict over the Crimea region at the moment. When suspicion and cautiousness start to appear around about late last week, the market really did not seem to be taking it into account. Downwards US GDP still resulted in the S&P closing a record level. Dow Jones seeing upward movement as well. So really the market was not reacting that negatively to the conflict as such on Friday. But come this weekend, obviously situations have escalated. Politically, both parties seem to be in a standoff with strong rhetoric on both sides, and the Ukrainian Prime Minister certainly has been seen saying that the Ukraine will not stand down over the Crimea region, which seems quite difficult to believe that there seems to be any easing in the situation, considering that the Russians are already entrenched in the region and have given a deadline of 3 a.m. GMT for the Ukrainians to stand down tonight. So we could certainly see some further volatility in the markets. Obviously on the open for the market today, starting off with the Asian session, markets took a giant hit. A huge downward pressure on the open with the so we can certainly see here off the bat the Nikkei dropped 200 points in the space of about half an hour from the Japanese opening, and it certainly kept falling over the Asian session. Same goes to the Dow Jones, and Australian index also fell around 90 points, which is certainly irregular and a very large move, considering the average ranges for the Australian index. The early morning session, the Forex markets did not seem to react too much to the well, certainly the currencies didn't seem to react too much to the situation in the Crimea. It seems that most of the damage was dealt to the equity, and definitely going into the morning session, Germany, which does an awful lot of business with that region, gapped lower and just kept on falling. So Germany today, at the close today, closed at the German session down about 310 points. And certainly it's still down right now during the American session, down 278 at the moment. Same goes to the UK. So there seems to be a general broad, if we look at the equities indices as a whole, the indices, there seems to be a clear-cut reaction by the market in the sense of a huge sell-off in the risky assets spectrum. One of the worst hit actually was the Italian 40 index, down 700 points, which is just phenomenal. So definite market volatility and fears over this coming conflict, and it's certainly a situation where if it escalates, we could see more market downward pressure, and if there is certain easing, then we could see a resumption in the upwards trends for equities. Going on to the commodities index, as you can see here from this window here, obvious contrast to the indices. Huge buying of commodities. As one of the biggest movers today was wheat and corn. Ukraine being considered generally the bread basket in the markets, in the sense that it is one of the biggest producers of wheat and corn in the world. So obviously a conflict in that region escalated prices, definitely set the prices up moving. So if we were going to look, I'm going to pull up the chart for wheat right now, just so you guys can see the reaction. So just pulling up. So wheat right now seems to be testing its 200-day moving average, and the chart for corn is very, very similar. The interesting thing about food prices is, as you can see, so here's let's just keep this analysis just now. So it seems that the wheat market certainly is retesting its 200-day moving average. Food prices as a whole on the commodities market have been drifting lower over the past few months, so certainly we could see further upward movements in food commodities. So as a whole, if the commodity price rise keeps going on, we could see further inflationary expectations on commodities. Certainly a great example of in the commodity market was also the gold. So if we look at gold right now, there has a rather large bearish sentiment against gold over the past few months, but as you can see, there seems to be bears seem to be getting flushed out over the last few months, and certainly today the gold snuck past its 1346 previous resistance level. So we could be seeing further upward pressure. We could see further rises in gold, certainly if this situation escalates, starting to retest the 1400 levels from early September. So that could be eyed. So if it manages, right now the current resistance level it faces will be 1360, and if it moves through there, then it could be an easy ride back to 1400. Obviously gold rising due to movements from the risk asset spectrum and back into safe havens, so I will be showing that later certainly in the yen charts, which are reflecting this. Oil, we've seen a stellar rise in oil lately. The one I'm most interested in is crude oil, West Texas, which has broken through its 104 level. So this is particularly interesting. If we're looking at the prices, some of the analysis, technical analysis, certainly points to a potential move to 106, having formed a jump over a bull flag pattern. So just some of the price projections certainly seem to point at 106 being a great candidate for prices in the next few sessions. Brent crude also currently sitting at 110. Price projections pointing towards potentially 113. Failure to take these levels, movement to the downside, could see crude WTI going back towards the 101 levels. Assets, safe haven assets and equities have been behaving as traditionally they're expected to during times of conflict. Lots of safe haven buying, lots of fleeing from the equities markets. Over the next few months, we could see a continuation of this pattern, considering that there's also escalating geopolitical tension in Venezuela and Thailand. Moving on, emerging market. I'm going to pull up one of my pre-made tables. The Nikkei market reacted negatively, as I said before, dropping to a low of 14,432, which has previously been significant support. It managed to hold that level throughout the early morning session in Asia, and also throughout the European and US session. But what is more concerning to me personally is looking at the emerging market currencies and emerging markets. Growth has not been as great as it was in 2013. 2013, the Nikkei was one of my favorite indices to trade. This year, since 2014, it has been falling and is certainly struggling to retake its highs of 1600, as was seen in early January, end of December. So I'm going to explore a few ideas could be related to this. First of all, looking at US Treasuries, if we pull up the 10-year bond, yields have, sorry, bear with me as the chart loads. Yields have been dropping. Price has been rising since early 2014, and it's right now sitting at this level from early January of 135, 44, 45. So, and this seems to be on course the price seems to be on course to keep on rising. Looking at dollar yen, I think there could be scope for this currency pair to drift lower. It has repeatedly failed to retake the 102.80 level, and that seems to be in a downwards trend. So with relation to bond yields dropping, we could be seeing a retest on the downward side of the 101.2 regions for dollar yen. Also, as you can see from the December highs, of course, 106 of 106, it seems to be falling, seems to be positively correlated with the Nikkei market. So with treasury yields dropping and the Nikkei struggling to retake levels above 15,000, we could definitely see more downward pressure on dollar yen. There are those who argue that the Bank of Japan is soon to be announcing its stimulus packages. However, it needs to be realized that that's not going to be for until at least April, which is 4 to 5 weeks away, and until then seems to be the situation where emerging markets carry on to be taking a hit, and the emerging market currencies as a whole seem to be drifting lower. So we could definitely see further downward pressure until more stimulus is announced for, especially for dollar yen. So moving on, for the coming week, we have significant data coming out from Europe. We have PMI, well, today French PMI beat expectations but still showed a contraction. There are those who suspect ECB to announce a rate change, but that is highly unlikely considering last week we saw core CPI year on year up 1%. So from the ECB meeting this week, we could be looking at, well, traders more looking towards the inflationary expectations from Draghi's speech. So there is less of a chance of any rate cuts, as some are fearing, but more inflationary pressures from the commodities markets could give a better expectation for the rates to certainly stay on hold at what they are right now, or more chance for rises in the coming months. On Wednesday, Italian, Spanish, French and German PMI are out, and also we're looking at final iteration of EU fourth quarter GDP. German retail results were very positive previously, so there could be results could be quite good in that sense for quarter four GDP. Certainly from the UK front, results have also been very positive for retail sales, and so it'll be interesting to see what comes out there. Just moving to the UK market, there today in the FTSE, Aberdeen Asset Management was one of the worst to be hit. Just pulling up the UK 100 charts right now. Again, the FTSE 100 dropped 100 points, down 100 on the close, with obviously the Crimean situation blamed. But Aberdeen Asset Management down 4.19%. due to its exposure to the emerging market. Aberdeen Asset Management, one of the worst hit, and the broad spectrum in the UK market is a major sell-off across all sectors. So certainly from the UK, mortgage approvals are at incredible highs. They just came out at 10%, which certainly points to fears which investors and traders have had over the last a big asset bubble again in the UK housing market. So that is one of the fears Carney has been addressing. So the help to buy schemes which have been launched by the UK government have certainly helped this the mortgage approvals to rise higher. So we saw that there were a lot of NPC members, voting members, speaking about the fact that UK consumers need to start bracing themselves for a rise in interest rates, which has been propping up the pound. Looking at the major forex pairs, I'm going to pull up some of the charts for major forex pairs. Euro dollar has been touching the 138 levels. So pulling up the chart, so as we pull up the chart right now, it's starting to drift below trend line resistance. 138 level, the 138.35 was seen as major trend line resistance, and it is starting to drift lower. So we could see, certainly we could see it to gradually drift lower against the dollar. More interestingly is pound dollar. Cable certainly, well, I'm certainly seeing more of the opposite in terms of potential. Currently sitting at the 166.63 level. Technically, we could see further rises in this currency pair. So there is some selling interest above the 167 level. It did obviously test the 166.7 level a few sessions ago. The rise, but certainly there could be some correction with respect to cable at the 167 level. Broadly speaking, UK economic data has been outperforming US data, so we could certainly see further upward movement in pound dollar. Over the next few weeks we'll be over the next few sessions, I think construction data will be out, and the expectation for construction data seems to be lower with awful weather this month. Over the February season seemed to be cited for a potential drop in construction numbers. So that could market seems to be pricing in this drop. So over the next few weeks, we're definitely looking at a lot of US data coming out. We had manufacturing PMI, US ISM data, manufacturing coming out slightly above expectations, and non-manufacturing data comes out also later on this week, with expectations being slightly lower. Over the last month was certainly disappointing, with a 4 to 5% point drop in non-manufacturing ISM data. But the major event that we're going to be looking at will be US non-farm payrolls, as always. 150 expected is the number, which to me seems quite optimistic. We could see an upwards revision or a downwards revision for the January number, which was 113k, and of course December number was 70k. So still a lot to play for over the next week. It is certainly one of the more interesting weeks with respect to the escalating tensions in the Crimea regions. So to those out there trading, stay out of trouble. And good luck. And this has been Mohi speaking on behalf of Heriot-Watt University Trading Investment Club, and I will see you all next week.